So today's the idea is that we are planning to we'll see that how we can use different quantitative methodologies for actually creating some trading strategy. Okay, so what we'll be doing is that the idea for the agenda would be something like we will be going through the few statistical methodologies, as in what is the theory behind that, and then we'll be moving towards on actually building something in Excel and then deploying the same in R. So this time what we have done for this webinar, that we have had this entrance which had some bit of quant statistics and options related questions in it, and I understand that most of you have actually scored good, and actually only those who had scored good were given the links. So in that case, I'm assuming that there is sufficient base for the people, for all of you, to understand what we are going to discuss now. All right, so first, to start with, what exactly is quantitative trading? So quantitative trading is nothing but whenever you're using quant, that is statistical methodologies, mathematical computations, all those things for creating model, and not just creating model, but also for when you're deploying them or when you are doing the execution. So at every step, backtesting, benchmarking, every step you're using the system, using the quantitative methodologies. So it's about so that is in a nutshell is what quantitative trading is. So when we have different paradigms of trading, right? So we have fundamental analysis, we have trading based on technicals, we have trading based on quant. So quantitative trading, you can say that it is not something which is like a different league altogether, but it is it can also be seen in, say, fundamental trading, or in the technical analysis. So all those places also we have sufficient amount of trading, sufficient amount of usage of quant which is there. And for example, in technical analysis, you will see that you will have a lot of strategies in which you are using the technical indicators, right? So so technical indicators are nothing but some mathematical functions. So whether it be stochastics, or as in, or percent K, percent D stochastic, or whether it be your moving averages or MACD, anything, it's all basically the same thing, right? So it's basically using the similar kind of mathematical formula. So that's where the quantitative models comes into the picture while doing it. And same thing holds for the fundamental analysis as well, in which what we typically do is that we have factor models where we are looking at different P's and all, like price to earning ratio, or predicting EBITDA. So all those things, again, we use different statistical things which are there. So so yeah, so that's how we use quantitative trading in various domains. All right. So now the idea here is we'll be building a statistical arbitrage trading model using statistical approach, which is the most scientific approach as per our understanding, and we'll be discussing the statistical toolkit that you need for creating that kind of strategy. Then we'll be strategy building on Excel, and then the basic demonstration on R. Great. So I'll just show you a sneak peek of what we are planning to do. So we are planning to build something like this, say for two stocks, say Axis Bank and ICICI Bank, and we'll be putting in some parameters, some input parameters, and we'll be using these parameters to create the model. So for creating a pair and then generating the signal and creating the trading, implementing that model, right? So this is what we are planning to do. But for doing all this, what we need to know in advance is that these are the few things that you need to know. We'll try to keep it short so that we can focus more on the practical side, but still there's something that is necessary something which is necessary before you jump on the practical side. So first thing is that I'm assuming that most of you are comfortable with the say bit on the probability and distribution, say what is normal distribution, what is log normal distribution, and say what is correlation, regression, all these things. So with the keeping a assumption over there, we would like to move one step ahead, and we would like to work right from co-integration. So co-integration is something which you use for judging the statistical properties of two time series. So in this case, we are having two time series, say Axis Bank and ICICI Bank, for example. In that case, the either you can go for the you can go and check for the correlation, that okay, this is the correlation between these two things, and if these are correlated, then I can do a pair trade, which is you can say an archaic methodology. So like it was proved in 1978, 1979 itself that kind of thing is open to very, very spurious interpretations and very, very dangerous outcomes, right? So so the thing is that co-integration is a much better approach when you're looking at the pair trading for the pair trading, or for evaluating the statistical properties between two different time series. So that is there, and we have so just going by the definition, two time series are co-integrated if they have a common stochastic drift. So what do we mean by common stochastic drift? So it's basically the change of the average values of a stochastic process. So for any stochastic process, we if the change which is happening in the average values of the stochastic process, that we call as stochastic drift. For example, if we have, say, we are doing a coin toss. Okay, so the average for a coin toss, the probability of a head as well as for the probability for a tail, that is half, and so every new instance that we are doing, every new experiment that we are doing, for that the stochastic drift would be half in that case. Another example, but not very established example, but similar kind of example would be, say, stock prices, in which what you have is there is a common stochastic drift. Typically, you can assign it to inflation as well. So because stock prices are the nominal values, so nominal values, they keep on they are open to the inflation. If there is inflation in the economy, then automatically the prices will go up, right, in long term. So that's something which is a stochastic drift that you can say. There are other input there are other parameters as well, but we are just looking at this for the time being, just for the example. All right. So but how to test whether two series are co-integrated or not? So what we do is that for two individually non-stationary time series, if there exists a linear combination of the two time series that is stationary, then the two series are co-integrated. All right. So let's try to understand it in a deeper perspective. So say, for example, say like I mentioned the example of a drunk man and his dog. So if there is a drunk man who is wandering around on the street, and there is a dog who is also wandering around the street, so if you look at them individually, there would not be much of information that you would be able to figure out by knowing that, okay, if I know the location of drunk man, you do not know anything about the location of his dog, right? But as soon as you tie his dog with a leash to the drunk man, in that case, independently, still they are following a random walk or some random process. But if you look at them together, in that case, what you will be seeing is that you will always say that the dog is within the R radius of R being the length of the leash. So within that radius of the man, right? So that is when we call that these two things are co-integrated. So independently, nothing is there, or it's not that much there. But if you look at the linear combination, then you would be able to find out that there is it's a stationary series. The relation is much more stronger, right? Now we mentioned that to test this for two individually non-stationary time series, there exists a linear combination of the two time series that is stationary. So what do we mean by stationary and non-stationary? So now the stationary time series is a series in which the statistical properties like your mean, your variance, that is not changing over the time, right? So it's more or less the constant over time. So that is what we call stationary. So now the thing is that if you have a series, time series, which is stationary in nature, in that case, the prediction of the for the time series, because what we are doing, say even while modeling a paired strategy or any strategy, is that we are trying to predict that what will happen next, right? So to predict what will happen next, we need to make sure that if the time series is stationary, and you know that the statistical properties are going to remain the same, more or less the same. So in that case, it is much more easier to predict the time series. For example, say if we are looking at a series and we're saying that okay, the mean would be around this. So I have new entry. So say let me show you just one example. All right. So on this Excel, say I have series 1, 2, 5, 4, 8, 9, 3, 5. Right. So so if this let's assume that this series is stationary. So in that case, what will happen is, say if I am taking the average of say 4 things, and if I drag it down, so if the average is going to remain the constant, then as soon as there is a huge change or an entry which is like really outlier to the rest of the series, in that case we can say that since the mean is going to be the same, then probably the next entries are going to be much smaller in magnitude, right? So there is some help that we are getting in predicting the time series if we know that the time series is stationary. So like mean or variance is stationary, right? So that is why we say that a stationarized series is easier to predict, and since you can predict the statistical properties, therefore it becomes easier for you to predict the future values as well for the time series. So to do the stationary test, so now the thing is that to test for co-integration, we need to test whether the stationarity is there. So if there is a linear combination of the two time series which is stationary in nature, we know what stationary is now. So if you go into the text, then you will see there are different kind of stationarities, like you will have trained stationary or different stationary. So all those things are there. We can I can tell you a bit about that as well. So yeah, okay, let's go. Let's do a bit on that as well. So like there are different kind of stationary processes. So one, the two main processes are like trained stationary, and the second is your difference stationarity, right? So when you say that two processes are trend stationary or the time series is trend stationary, in that case what we are saying is that the y, so like over here we have yt equal to rho yt minus 1 plus ut. So instead of yt minus 1, we have a function of t, where t is the time, right? So my value of the current value of y, as in my current value of the time series value, that is depending on the time, right? So that is trend stationary. So as the time changes, the value is also changing with that. And similarly, if the value is say yt is equal to, for this particular thing that I mentioned over here, yt equal to rho yt minus 1 plus ut. So in this, what is happening is that yt is depending on the previous value of y, right? So that means that this is different stationary. We'll discuss in a bit on what exactly do we mean mathematically about that. So anyway, so now back to the stationarity test. So this is basically, you have a very simple test, which is Dickey-Fuller test. So this is named behind after the two researchers who actually build up this test. So what we need to test is that we need to test for the unit root in an autoregressive model. So unit root is say over here, so this row. So if rho is equal to 1, then a unit root is present and the series is non-stationary. Because the thing is that if the row, this unit root is less than 1, in that case, you will be seeing that the series is a decaying one, right? So the value is decreasing. The so the value is going towards 0. So in that case, it would be easier to predict the statistical properties as compared to if rho is equal to 1 or more. In that case, you would not be able to eliminate the stationary non-stationarity from the model, right? So the idea is that what we want to do here is that we want to derive a stationary series which we can use for predicting the model, right? Okay, all right. So as I was saying that for two different, say, trend stationary and something like, I'll just give you an example to hopefully that will help you understand it better. So these are, say, different values, and this is time. So if these values are, say, changing with time, as in they are increasing, decreasing with time. Say it's I do it 1.4. So these are values. These values are increasing as the time is going down up, right? This need not be constant. I'm just taking it for the example's sake. So this is a trend stationary time series. Vis-a-vis, we have, say, difference stationary. So that would be like this value is depending on, say, this value, say the previous value. Okay, so basically if I have 1, then this is, say, this plus the whatever 5 or something. So this is something which is difference stationary. So why do we give this name? So like trend stationary, the name is from the name it's clear that since this is changing with time, so this trend stationary. So the thing is that this in itself is not a stationary series, but if we do a regression with two of these series, then what we'll have is, say, let's do a simple regression, and my y is this and my x is, oh sorry, x is this. So we do regression, I'll get simply 1.4 because that was anyways the constant part. Even if I change a bit, then also it could be somewhere around that. So 1.4 with a p, very small p value. So that means this is significant, statistically significant. And if I know the regression, then what I can do is that I can always do this thing like this minus, say, 1.4 times this, 1.4 times this. So that will be making my series stationary, as in this is becoming 0 because all the values are like exactly we have taken it from the formula. But say if the values were like this, then this would, all these values would be very, this series would become stationary, right? So this is for trend stationary. So the series is not stationary, but if we remove the trend, then it will become stationary. So that is doable. Another is difference stationary. So in that, what we do is that we take the difference. So this series again is not stationary in itself, but if we take the difference, then it comes out to be quite stationary, right? Again, you can have like the not exactly the same numbers, but yeah, more or less a similar kind. So that is what we mean by stationarity and trend stationary and different stationary. And you already now, I understand that you understand the the significance of creating a stationary series, right? All right. Now, the simple thing like why do we use co-integration over correlation? Like I was saying in the beginning, that why do we do that? So the first thing is that co-integration gives a better estimate for short-term predictions. Okay, so if you are predicting prices in say in a shorter term, in that case the co-integration is much more likely. It has been proved empirically as well that it will provide you much better estimate as compared to the short-term predictions. Now that is one thing, so it's better, that's great. But why we should not be actually using correlation is a different reason that is mentioned on the second point, that is spurious correlation. So that is, say, spurious correlation happens when we are looking at two things which seems to be like correlated with each other, seems to be highly related. So like in data. So like for example that we have taken here is these are all the examples, are textbook examples kind of. So like ice cream sales in a city vis-a-vis the drowning casualties in the lake or say in the swimming pool. So what happens is that you will be seeing that okay, it is possible that both of them are looking quite close, as in the relationship is very strong, but what is happening is they are being determined by a different variable, which is the temperature, right? The high temperature. So the weather is very hot and more people are going out for having ice creams. That's why ice cream sales are booming. And also more people are going out for swimming, and since there is some small percentage which in which the casualties can happen, so the casualties are also increasing, right? So so both of them look, if you look at them individually, it looks like okay, there is a strong correlation, but it is being determined by a third thing. Now the catch here is that if it was only the heat which was determining the was a determining parameter for both of these processes, in that case it was okay. It was it would not have been a very spurious thing. But what makes it spurious is that it might not be just dependent on the temperature, right? So it might be dependent on other things as well. So like number of pools in the city, or number of ice cream parlors in the city, or number of people in the city. There would be so many different things which can impact both these series. So what happens is that if you look at, if you are just looking at the correlation, in that case you will not be able to figure out anything about this. But if you're looking at co-integration, what is happening is that we are trying to make it stationary, right? So all these series, what we were doing was we were trying to make them stationary. So if there was a common, some common thing, some common parameter, then when we take the difference, so we are taking the linear combination of the two and we are trying to make that stationary, right? So if there is only one such parameter, in that case what will be happening is that okay, it will got cancelled out. So the parameters for the heat parameter in both the time series, when you are taking the linear combination, you can cancel it out. But if there are other factors as well, if there are other factors which are present as well, in that case you will see that the series is not becoming stationary, because those processes are not stationary processes, right? So that is why if you're looking at co-integration, you would most likely be spared from this kind of fallacy. But yeah, but in correlation these kind of things do happen. That is there. And so this is this is what we are using mostly for today's strategy creation. And another thing is that even in execution, how we can use, we will not be doing it today because it's another exercise altogether. But just wanted to introduce you to the to this that there is something called causality. So Granger, who got the Nobel Prize in economics for this only, so he said that correlation does not tell you that. So say if there is a strong correlation between Nifty and Reliance, but let's say we are trying to take the example for Nifty versus USD INR. So correlation, you see that if there is a correlation, you will see that okay, there is probably some negative correlation between the two, and it is like you will see that it is justified in the sense that if the economy is doing good, then the rupee is most likely to appreciate, and if rupee is appreciating, then economy is doing good, then Nifty will also go up. So in that case, there would be negative correlation which you will be seeing. Some USD going down and Nifty going up. Do not need to it does not need to hold empirically always, but in theory you can say that okay, you can expect some correlation between the two things. But that doesn't tell me that is it Nifty which is causing the movement in USD/INR, or is it USD/INR which is causing the Nifty? So what we have here is that there is a model called Granger causality. What that does is that it takes the past values of Nifty. Say it will take the past value of Nifty and USD/INR, and first it will take the past values of both Nifty and USD/INR and see if the model is able to predict USD/INR. If it is, in that case, what we are saying is that Nifty is Granger causing the USD/INR movement. All right. So like what we have mentioned in the second point is time series A. So say Nifty is said to Granger cause time series B, that is USD/INR, if it can be shown using statistical test, so like t-test or other tests on past values of A and B, that they give statistically significant information about the future values of B. Right. So it is not necessary that you will always find a causal relationship between the two time series, but if it is there, then you will be able to see that if you run the test. So, so it comes handy in cases of, especially in high frequency trading, where the profit margins are very thin in terms of like profit margin per trade. So you'll have very small profit margin, and you cannot afford to give bid-ask spread on both the legs, right? So you would at least try to save the bid-ask spread on at least one of the legs. So you will quote on that leg as per the spread that you are trying to trade, and whenever you're getting the fill, you will go and hit the market in the market or the marketable or limit order in the second leg, right? Just taking a simple example. So what makes it important, the causality thing, is that if you know which one is causing which one, then you would be able to know that on which leg you should be quoting. The reason is that if you're quoting in something which is leading, right? So this is basically lead-lag relationship that we are trying to establish. So if we have, say, Nifty is leading, in that case we can quote in Nifty, and by the time we are getting the execution, we are getting the fill for our order, we are sending another order on USD/INR after we receive the fill. So if USD/INR is lagging Nifty, in that case the chances of getting the slippage is very less. So this whole exercise is to control the slippage. So so that you get better execution prices. So it becomes very important in that. All right, so that's about theory. Let me see if you guys have any questions on this. All right, so so we have like Neeraj is asking that is co-integration methodology can be applied for portfolios performance? Yes, you can. In fact, there is this paper by Ms. Alexander Carroll, which talks in very much in details about how co-integration can be applied for the portfolio performance. All right. Okay. Great. So let's start on the model then. Okay. I have this made, but what I'll do is that I'll make this again in front of you so that you can actually follow up step by step on what's exactly is happening. All right. So what I've done is that I've taken data from Google Finance, and this is for Axis Bank. This is for ICICI Bank. These are 5-minute closing prices. So this Axis is my X and ICICI is my Y. All right. So this is for I think 3 days or something. So it would be about 200 or 220 data points. Okay. All right. So so we will be doing a step-by-step process. So first thing to do is that we are trying to trade this pair, Axis and ICICI. But first we need to establish that whether there is a whether both these series are actually co-integrated or not, right? If they are not, in that case, I should not be Either I should not be trading it, or I should be doing something to make the process stationary first, right? All right. So as you all understand, would know that stock prices follows a log normal distribution, and similarly your returns, they follow normal distribution. So either we can so like when we do correlation, that is the reason why we always do correlation on the returns and not the prices, because the thing is that if you're doing it on prices, say if I do on both these things, so now the change that is happening, so like 15456.55, 1456.5, so 0.05 is the change that is happening. So 0.05 is much smaller to, and this is 0.05 and this is 0.2, right? So this is so much smaller than the magnitude of the level, that is 1456, 1226. So you will be seeing a correlation which is very high, but which is not correct. So what you do is that you actually do if you're running a correlation, then you should be running it on the returns. For co-integration, we do not have such issues, but what we'll anyways do is that since we are taking the prices, and stock prices follows a log normal distribution, so we try to keep everything under the normal distribution when we are doing it, when we are creating a model, right? So as close as possible. So so what we do here, what we are doing here is that we are taking the log, so that is ln of this price and ln of this price. Okay. All right. So first we take the log and we take the difference of the two, this x minus y, and we'll see if this time series is stationary. All right. So ln x minus ln y. So what we are doing here is that we are trying to establish the fact first that whether this is stationary or not. So we have a macro which I downloaded from the internet Pear's log portal. So there's a simple macro which helps us in testing whether there is whether the series is stationary or not. So if I do this, values only. So if I say start ADF test, okay, start ADF test. So we are seeing a p-value of 0.67. So now the p-value, the significance of p-value is that what it is saying is like there is a 33% probability that this series would be stationary. So the null hypothesis is that this series is not stationary. So not stationary is coming out to be around 67%. So which means that this series is very less likely to be stationary. All right. So we have an issue here. So how do we resolve that? So if you just realize what I have done is that we are taking a pair. So this is ln x minus ln y is nothing but say ln of this by x by y. So it would be the same value, right? So this is nothing but we are taking the log of the stock prices ratio. Now we would like to do something which can make this thing stationary. So let's see if I take the difference. So I'm assuming that say if it is trends, if it is difference stationary, in that case, if I replace this, okay. If I replace, put this time series over here and see, then amazing. Then what I see is that at 99% confidence interval, it is telling me that the time series is, this time series is stationary. So that is great. So what I am doing then is that I will be using this time series for the prediction in the model instead of using this one, because I would always like to go with a stationary time series. Okay. So this was a simple thing that we did to create the time series, to make the time series stationary, right? And as we saw that it is easier to predict, and it is more reliable. The prediction is more reliable if the time series is stationary. All right. So now all we have to do is we have to do the simple modeling exercise. So which is we have to generate a signal. We have to generate a we need to look at the take profit and stop loss, all those things to create that. All right, so let me freeze this pane for doing that. Okay. All right. So now the next thing is to generate a signal. But to generate a signal, what do we need to do first? What we need to do is that we can do is that we can create a Z-score. So Z-score is you might have if you're like you all would be familiar with the normal distribution. So the Z-score is to create a process standardized to a standardized normal distribution. So you use Z-score. And how do we do that? Z-score is nothing but your just a sec. Z is equal to X minus mu by sigma. So my Z here is basically the Z-score. My X is the individual value. So for a time series, this mu is the mean. So this is say X hat, you can call it, or whatever you want to call it. Mu we say in the normal that, and sigma is the standard deviation. And X is the individual values of X. So so time series, my time series is Xi. So X1, X2, X3, and so on, right? And over here I have mu, which is sigma of, or say X1 plus, X2 plus, X3 plus, and so on divided by n, right? So this is my mu, that is the average, and sigma is your basically the standard deviation for the same this time series only. All right. So and this is Xi basically. So X1 minus mu by sigma. So what it helps me in doing is that that the series that will be coming, the Z, this is standard. This is something which would be following a standard normal distribution. So that helps in the overall exercise. So anyway, so for doing that, first what we need to do is that we need to calculate the mean, that is mu, and we need to calculate the standard deviation. All right, we'll be doing everything on this series because there's a stationary one. All right, now what we can do is that how many we should be taking the mean of how many points, how many Xi's. So typically, if you want anything statistically significant, then it should be at least 30. 30 is the number where you have like say in case, for example, if you want to in your portfolio you want to diversify without doing any much research, you can anyways just hold 30 different stocks, and that will almost assure that you have diversification at a of a very significant level. So what we will do is that we'll take the mean of 30 such levels. So to calculate the mean, there is nothing but average. We always take the past values. We never take future or current values while modeling. Otherwise, it can give you some very good results and very good looking results in terms of profitability, which would not be holding true otherwise. All right. So this is my mean, and this is same as TDEV. So TDEV again for the same series, 30 points. All right. So we have the mean, we have the standard deviation. Now what we need to do over here is the Z-score. So the Z-score as we saw, is nothing but x minus mu. X is this, mu is this, by sigma, which is this. So we have z score over here. All right. So this z score is basically telling me that how far the score is from the mean. So in terms of deviation, so this is 0.33 standard deviation away from the mean. This is 1.24 standard deviation away from the mean, so on and so forth. So what we do here is that what we'll be doing is that we are putting in buy threshold. So these are the parameters. So like buy threshold is minus 2 times sigma. So that is the 2 standard deviation away. If it is below 2 standard deviation, you would like to buy. So 2 standard deviation is almost say covers, in a normal distribution, it covers 95% of the traded values. So if this score, if the value of this series, it's going say in that 5% range on either side, then you're saying that you would like to buy or sell. If it is on the lower side, you'll be buying the pair. When I say buy, it's buying the pair, right? So x, since we have done ln x minus ln y, so if we are buying, then we are buying x and we are selling y. All right. Okay. So how do we generate our signal in that case? So your signal would be if this thing, this number of in terms of standard deviations, this thing is less than this thing, then what you say, it's buy pair. Okay. If J39 is greater than this thing, then I would say that it's a sell pair. If it's nothing, then I would do nothing. So you're getting this sell, sell, buy, forever, right? All right. So now next step is to find out the prices at which we are buying or selling this. So pair buy and pair sell. So my prices would be, so what I will be doing is that if this is equal to buy, in that case I'm buying X. So my price at which I'm buying is this price. Similarly, if K39 is equal to sell, then I'm buying at this price, right? So in fact, we do not really need to, since there are only two possibilities, buy or sell, so we do not really need to put this if, but anyways, we have just placed it. All right. So since this is a sell, so what we are seeing is that it's a sell, like it's we'll be buying ICICI if we are selling pair. So this price is coming. Similarly, if we want to say that if this is equal to buy, in that case we are selling ICICI. If this is equal to sell, then we are selling this, right? Otherwise nothing. Right, we missed on something. Okay, we instead of L, all right. So now we know that what the signal is. So this was 2.60, so which is way beyond 2. So we have a sell signal, and this is pair buy, this pair sell. These are prices. Okay, now the next thing is that what I need to do is that we need to, I hope everyone is following. If there are any issues, you can drop in a question. I will try to keep on looking at it. Okay, there were some questions. Okay. All right, let me take this take these questions. Pankaj, can co-integration be used in Excel? Yes, you can, but you will mostly need a macro that just like we used over here to test the stationarity. But otherwise, we are anyways using it, so it's different stationary. Yeah, number of standard deviation we are away from mean. Yes, I think we're taking last Friday's mean, not mean of the complete data, and using same model. Yes, just me. See, the thing is that what happens is if you're when you're modeling a strategy, you cannot look into the future. So when you are at this time, say let's assume this time was 10:15 yesterday. So when you are at that time, you should not be looking into the future. You can always look into the past, because when you are actually trading, you do not know what price would be at 10:25 when you are at 10:15, right? So that is the reason um, why we see only in past. Cool. Thanks. All right. So yeah. Now next thing is okay. So we have had the signal, and I'll just minimize this for the time being. Okay. Oh. Huh. So so next step is that we now I have this sell trade which is there. I need to know what the sell trade, what is the status of this trade in the next column, what is the status in the this trade in the next, in the next row. So in, till the time my take profit or stop loss has not been hit, right? Okay, so for doing that, what we need to do is that we need to create a status column which will keep on telling me that boss, this is your this is the status of your trade right now. So what are the different statuses which can be there for any trade? One is definitely either you're bought or you're sold. So or you just hit your take profit, or you just hit your stop loss, or there is nothing, right? So these are the 5 possibilities which we can expect in this column. There is nothing apart from this that can be there for this model at least. So what we'll do is that we'll see for all these 5 cases that in this previous column, what was the case. So if I'm using an OR function to look at the multiple possibilities, if this is blank, or N50 is equal to TP, or N50 is equal to SL. SL is stop loss, TP is take profit. So if it's either of these 3 things, then that means that my in the current row, in the current time frame, I do not have any trades running. So because there were anyways no trades running in the previous cell as well, or there was a trade which was running but it has just hit stop loss in the previous cell, or the it has just hit the take profit in the previous cell, right? So what we'll be doing is that if any of these 3 cases is there, then we'll just pick the whatever signal is coming. So if there is no signal, there would be nothing. If there is buy, it would be buy. If there is sell, it would be sell. Now second thing is that if it was actually a buy, so there was a buy trade which was running. Okay, so for the buy trade, what we need to see is that if there is a trade running, then we need to keep on calculate whether what is the mark to market for that trade right now, and compare that with the stop loss and take profit levels that we have provided over here, right? So for doing that, what we'll be needing is that we will be needing your buy price and sell price. So for that buy price and sell price, we need in that case we'll need the same price at till the time the trade is running. So if the buy is running till here, or the sell trade is running till here, or say till here, wherever. So for that time period, we need these 2 prices to be repeated in the cell so that we can do our calculations. Okay, so what I will do is that I will just create two more. Okay. So what we are planning to do here is that we'll be I just placed an apostrophe over here because this formula is under like we'll be working on this formula further. So we have just stopped it for the timing because we need buy and sell values. Okay. Sorry, the buy price value and the sell price value. So what we can do here is that if I want to repeat whatever price it has, the pair has been bought and sold at. So for the buy price, if the status where we'll be seeing any of these 5 values, buy, sell, take profit, stop loss, or blank. So if this is equal to this, right, or so I'll just put an or over here. If either this is equal to this, that means there would not be 2 successive TP and SLs, because what we are doing here is that we are taking only one trade at a time. So if there is a sell trade which is running and it has not hit its stop loss or take profit and another sell trade comes, then we are not taking that. We are only taking one trade at a time in this model. So so if this cell and the previous cell, the status in the in the current and the previous cell is the same, that means that either there is a buy trade which is continuing, or there is a sell trade which is continuing, or there is no trade and still there is no trade. These are the only 3 possibilities. Okay, now let's think about it. So, so if the buy is continuing, or sell is continuing, or blank is continuing, in that case I just want to repeat the previous value, right? Whatever value was there for the buy, pair repeat buy, I would like to repeat that value. So that's cool. And sorry, I have, and also in case if this is equal to, say, SL, the status is stop loss or take profit. So in that case also, I would just like to repeat the previous value, because there is nothing much apart from that, because if it's a stop loss or take profit which hasn't hit, that means there was a buy or sell price which was there. So I'm just repeating that. So if there are any of these possibilities, so either the status is the same or the status has just hit stop loss or take profit, then I am repeating the previous value. Else, now what I will be doing is that if, so a new trade is starting, okay? So in this part we have eliminated all the possibilities of say the continuation of buy or continuation of sell, or the stop loss or take profit being just met, right? The condition being just met. So what we have to do here is that if it's a new trade, so if K51 is equal to buy, that means I'm buying the pair. So that means I'm buying excess, that is X. So I'll pick this price. If K51 is equal to sell, then I'm picking this price, right? Because if we are selling the pair, then we are selling excess and buying ICICI. And if it is none of these cases, then I just want to keep it blank. All right. Now same thing we'll be doing for sell side as well. So that's, so again N51 is equal to N50, the status is the same, or stop loss or take profit has been hit, then I will just repeat the previous value of the sell price. So, or the sell price, so it would be P50, and if K51 is equal to buy, then it would be C51, because now we are seeing the sell leg, and if K51 is equal to sell, then it will be seeing it B51. All right. Okay. So now we have these two things which will keep on repeating till the time the status is the status basically depending on the status column, right? Okay. So back to the status column, we have done our homework over here. We will be repeating this once we complete this. So what we were doing in status column is that if N50 is equal to blank, or N50 is equal to take profit, or N50 is equal to stop loss, that is the previous status. If it was any of these three cases, then we are just taking the new signal, whatever is coming. If there is buy, sell, blank, blank. Now, what if the status in the previous column, previous row was buy? So in that case, what we need to do here is that we need to calculate the how much money is it making, right? So making or losing. Accordingly, we will be we can say that whether the stop loss or take profit has been hit or not, or whether the trade is continuing. Okay, so if N50 is equal to buy, in that case, what we have here is that this is my sell price. If this is buy, then my sell price would be the price of the leg 2. So the lot size I will be taking would be of the buy, that is ICICI. Because if N50 was buy, in that case, I have bought excess, sold ICICI. So my profit is sell price minus buy price initially plus sell price minus buy price when I am exiting. So P50 into B4, I'll make this constant, minus this thing into, or in fact, just to avoid the circular references in later on, what I will do here is that instead of using P51, I'll be using P50, because since there was a buy over here or sell over here, no, sorry, in this particular case, since there was a buy, so there must have been buy and sell values corresponding to this as well. So I will rather use that instead of using the current sell, because we are using both these cells intermittently. So there is a high chance that some circular reference can come in. So we can do this, and this does not impact us at all as in our model. So that's fine. All right. So this is my when I initiated the pair. So it was P50. So that is the sell price into B4 minus the buy price into B3. Okay, into the lot size basically. So this is what I had. Now, what I also need to do here is that in the current cell, what is the take profit? Oh, what is the M2M? So for that, since I have sold, since I bought this, so what it means is that I'll be selling the pair now when I'm exiting. So this is my sell price. So this will come first this time, B51 into X, the lot size of X, and minus. So this is what I'm selling, and what I'm buying, that is I'm paying for that. So that will be negative. So that would be C51 multiplied by 4. All right. So this is the mark to market for my pair. So if this is less than this thing, that is my stop loss, then I would say that I have hit my stop loss. Same thing. All right, we have forgot to mention if here. Yeah. So if this thing is true, then stop loss. Else, if the same thing, the formula remains the same for the calculating this is the mark to market, right? So if the mark to market is greater than take profit, then we have a TP. All right. So if the mark to market for the buy case is less than stop loss, then I have SL printed over here. If mark to market is greater than take profit level mentioned over here, then I have TP printed over here. All right. If it is none of these two cases, then I will just be repeating the status because it's the buy which is continuing. So I can mention N50 here or I can mention buy here. Anything will do. So that takes care of my buy case. So if N50 was buy, if the status in the previous cell was buy. Now what if the status in the previous cell was sell? So if N50 is equal to sell, in that case, it would be very similar to what we have done here, just that in this case, the when the pair, you're selling the pair, then you're selling excess and buying ICICI. So vice versa of what we were doing earlier. So N50 is equal to sell. In that case, this is your sell price. That remains the same. But what you will have here is that P51, that is the sold price, initial, that is the entry, this is the entry price. So sold price, since this we are talking about sell, so what we have is that we take the sell price, that means it should be of the X because we are taking the sell case. So we'll take this minus this. Oh, okay. We should be taking the previous one again, just as you mentioned earlier. This into y. So this is the M2M when we have just entered, and when we are exiting, in that case, we are buying this and selling this. So sell multiplied by this minus, we are only buying this with this. All right. So this, if this is the M2M, if this is less than this thing, then we print SL. Now I'll just copy this thing again, the M2M for sell. If this is greater than take profit, that is B6, then I print TP. All right. If none of these two cases, then I will be repeating the previous value, just like what we did in the case of buy. So this is done. All right, we forgot to mention it somewhere. Yeah. So, all right. So we have this thing sorted out. Now this is for the case. This last thing is for the case if the value in the cell in the status is neither neither take profit nor stop loss nor buy nor sell nor blank. So in that case, we'll just put in a blank. All right, and we close this thing. Okay, so we have most likely, yeah. So we have this sorted out. So what we have here is, now let's see. What's happening is that there was a sell trade which came in. Sell trade came at 12.12. So 1212. Pair sell 1453.1. So which is correct because this is the value of the ICICI Bank 1212. This is the value of the Axis Bank. So since we are selling pairs, so we are selling Axis, buying ICICI. Now we are continuing this till the time it does not hit either the stop loss or the take profit, right? And we are repeating the entry price over here to enable us to calculate for the M2M continuously. So when it hits stop loss, so if you look at it, the prices were 1212 and 1453.1. These are the prices at which we had sold and bought. And in this, the prices went till 1459.8 and 1215.55, right? So you can see that the thing that we had sold, so 1453.1, we had sold it, and it has gone up significantly. So there was one gap which had came for almost 9 rupees. So that's why or stop loss was hit. If you calculate the stop loss, it would be simple. 1459.8 is your exit price, is what you bought, and this is what you sold at. So you are losing almost 6.7 rupees here, and you're making about 3.55 rupees here, right? So you're selling at 12.5.55 and you bought at 12.12, right? So if you multiply it by 250, that is the lot size, then you will get the profit and loss, so loss in this case. Similarly, when you're bought, you hit a take profit because you're bought in 1453.65, you sold at 1448.95, that is loss of 5 rupees. But over here, you had sold at 1216.2 and you have bought at 1190. So which made 26 rupees here and lost 5 rupees here. So so that's how we do this. Now next thing is to just to calculate the take profit, and that should be that should at least complete the initial part of our model. Let me check for the question. So okay, Ankur is asking, can you share this Excel? This will help me to do review post webinar. Sure, Ankur, no issues. So we'll share the Excel with all of you. All right. So okay. All right. So next part is to calculate the take profit. Oh, sorry, not the take profit, the profit and loss. Just put this right from the this. Okay, so now to calculate the profit and loss, what we have to do is that the simple thing that we can follow, that if this cell is equal to stop loss or take profit, in that case, it's only then in those cases when you will be populating something in this domain, right? In this cell. So if or this is equal to SL or this is equal to TP. Okay. Then if that is the case, then if the previous cell, so if the trade was buy, then my take profit would be, I can directly take it from the status column because that is the M2M basically. So that I'll take. So let's copy it instead of spending time again on this. So for the buy case, my M2M is this. See, the thing is, what we could have also done is, if this is stop loss, then minus 600. If this is take profit, then 2400. But the thing is that this is not continuous data, and there might be gaps. Like over here, you made 21 rupees instead of probably 2.5 rupees that you were targeting. Oh, sorry, rather 9 rupees, 9 or 10 rupees that you are targeting, 215 to 9 point something. That will be 2400. So for the reason of the gaps, we are not taking the take profit and stop loss what we have mentioned directly. Otherwise, we could have. All right. So if this is equal to buy, then this. If N55 is equal to sell, in that case, we'll take the sell MTM value. That is this part. Otherwise, I'll keep it blank. False. And what if it is not SL or TP? Then also I would like to keep it a blank. All right. Okay, we have a positive value in SL. That means that we have made some mistake in the calculation somewhere. So, all right, that seems to be fine. This one is a issue. So in the case of a sell, let's see. In the case of a sell trade, we are having P54 into P3. So P54. In case of sell over here, that is N55. In that case, P54 into P3. This is P54 is my previous value. So why is it taking P54? It should not be taking that. It should be taking 55, the previous value. So any which ways. Okay. All right. This was the column that we should have been copying. So for sell. So whenever you're doing modeling, you need to, when you're getting an output, you need to check for its sanity in the beginning itself. Like here, we could just sense, because if it was a stop loss and we are not doing any trailing stop loss or something, so it is not possible that my loss number can be positive. So that's why you can get to know at once that okay, there's something wrong which has happened in the formula, and you can correct that. Okay. All right. So here now we have buy case, stop loss is negative value, so it should be correct. Sell case or buy case, take profit. All right. So this is where we have completed the model as such. So I'll just put in the okay. We have this thing. P&L. All right. And if I just do simple P&L over here, then it will be sum of all these values. Which is somewhere around 500 rupees that it is making. Okay, now there are so many other things. This is just very basic level of modeling that we are doing here, and even we are not doing any backtesting or benchmarking over here. But there are many things that we can do in the Excel itself using the formulas, and also you can go and use the VBA in Excel, and then we gradually move towards R. So that's how it goes in the program, in the executive program in algorithmic trading as well, that we start with Excel, but we do not let you continue with it for a long period, because that is just to understand, because most of the people are comfortable with Excel. So we start with Excel, then take you through VB, so because that is the next most popular thing among most other people who are working in the financial industry, especially on the trading side, and then we move to R. So obviously R is a different programming language, and it needs a lot of understanding and practice on your end in the proprietary language of R, which is not very tough, but yeah, you need to have some understanding. So for that, so what we'll do is that I'll just run RStudio. So over here, I have the code which is already there. So this is my code, and I'll just copy paste it to in the RStudio. So this is the open source platform, so it's much more computationally stronger as compared to say Excel or even VBA. So what you can do here is that you just add another R script. So this is a new R script. So I'm copying this from the program that I already have. So I'm doing Control V, Control A. So this is what we are doing in this program is. I'll just run this, and then I'll tell you that this is very similar to what we have done in Excel. There's something similar that we're doing over here as well. So this will also provide you a plot. So what it is doing is that it is plotting the data. So we are again in this as well. We are taking the data from Google Finance. So this is my pair and this is my Z-score. Now let's just briefly go into the code what we are exactly doing over here. So see, first thing is, first you need the data. So we are fetching the data directly from Google Finance. So in the Excel I was taking 5-minute data. In this I have taken the 30-minute candles. So for as many days as possible. So for 60 days I have placed it. Okay. Now so this is the data part. Then next is your after you get the data, then what you're doing is that you're running the similar thing. You're trying to create the Z-score, and you have the upper band and the lower band. So this is your upper band and lower band. So the color that you're seeing here, the green is your lower band and the blue is your upper band. And this is your ratio, the red thing, and the black line is your mean. Okay. So the upper band is at 2 standard deviations, we have mentioned over here, and the lower band is at -2 standard deviations, right? So so that is what we are doing, and then we are trying to calculate the Z-score. So for this, so Z-score for the time series that we are having, that is Axis and ICICI Bank. For that, we have this thing. This is the Z-score value basically that we are plotting over here. Okay, so there would be one in this time frame that we have plotted here, 0 till 35. So we